It's my first time here, as Christian said. I joined Skagen at the end of last year from the Norwegian Sovereign Wealth Fund, where I was heading up the China investments based out of Shanghai. A-shares or China is not necessarily a traditional hunting ground for value investments, but I actually found that it was a pretty good area to hone your skills as a value investor, given how volatile the market was. So before I go on to the investment case, I won't actually pick a Chinese one to disappoint you perhaps. But at Skagen, we're an independent long-only asset management company founded in 1993 and headquartered on the southwestern coast of Norway. We have about 8 billion euros assets under management across a number of active equity and fixed income funds. So why did I decide to join Skagen? Well, the first thing is that we identify ourselves as value investors, which was important for me when choosing my next platform. The way that we identify ourselves as value investors is having a contrarian mindset, which we articulate through concentrated high conviction portfolios. All of our portfolios are based on bottom-up stock picking. We are generally quite patient. The turnover in our portfolio is low, and we kind of use a common sense approach. So if things do look too good to be true, then they typically are, and we'd rather look at where others are perhaps not looking at that time. The main attraction for me as well is that we're guided by risk reward. Yes, we do measure ourselves against indices or benchmarks like most of you do, but we do genuinely focus on absolute returns. We want to be measured over the long term, and we want to grow our investors' capital. So Kontiki, which is our global emerging markets fund, we're about 2.5 billion euros assets under management. As I said, we're an emerging market fund, but actually up to 50% of our assets can be outside of emerging markets. Why do we have that? Well, it's to be able to look for emerging market plays that might not necessarily be listed in emerging markets. It's also an ability for us then to be truly unconstrained in our approach and give ourselves the best opportunity to do well for our clients. And I think it's worth bearing in mind that our active share is consistently above 90%, so we do actually take this investable universe and use it. Like most of you, we use a number of tools for idea generation. I'll talk a little bit about how we came up with the idea that we'll discuss today. They're quantitative. Everyone can do screens. We don't necessarily think that's the best way to find value opportunities. I think what we do have is we have a 25-year-old database of qualitative things that we've looked at, things that we can revisit over and over again, which I think is a really key advantage of the firm. Our portfolio construction, as I said, is relatively concentrated given we're a UCITS fund. It's around 40 to 70 stocks, typically at the lower end of that over the last couple of years. And what we're typically looking for, given our absolute return mindset, is around 40% upside on a 2-year view. And again, I think given our size, we do actually require a bit of liquidity. So $5 to $10 million is typically where we look for. So how does this work in practice? Well, if you look at the different sides, so of course we use an objective search. We look at value metrics. We have invested in one A-share company since I joined, which is Gree Electrical, which is the world's largest air conditioning manufacturer. Wonderful business, but already done very well for us, so I won't go through it today. But if you have interest in the A-share market, I'm more than happy to talk about it. We also look at complicated situations. We look at total value. That tends to lead us into conglomerates or where there are under-earning divisions within a larger group. Those can then be crystallized through a demerger or a turnaround of that business. Also, a lot of our ideas come through just the companies that we own. We end up going to suppliers, we end up going to customers. It's quite hard for us to explain exactly how that happens, but very often some of our best ideas come through understanding the value chain of the companies that we've invested in. And then because of that, we can have exposure outside of traditional emerging markets. we look for geographic imbalances. So a recent example of an investment made was high-speed train signaling system manufacturer Holysys, which is listed in the US. It's a little bit too small to be of interest to US investors, and it's listed in the wrong place to be of interest to Chinese investors. So again, those are the kind of imbalances that we try to take advantage of. Finally, the stock we will be talking about, we take, a lot of the risks in emerging markets are often through political risk. It could be macro risk, etc. And sometimes that risk can also be systematically mispriced. So we think there are opportunities for looking at markets that haven't performed very well and see if there's a reason why that may be overdone. And then, we have a lot of exposure to South Korea, which at times can be a frustrating journey when you look at corporate governance and shareholder returns, but we do see signs of improvement there. And I think, the valuations that you see in that market make it an interesting hunting ground. So just a little bit on the portfolio. Again, because of the way that we source of our ideas, we do end up actually having quite a large small and mid-cap tilt. So it's just an example, we have a relatively balanced portfolio between small, mid, and large cap names, which is worth being aware of when you consider our performance. So with the introduction out of the way, it's time to move on to our investment case. Oliver earlier said that you needed to be uncomfortable to be sure that it was a value case. Clearly, with the news picture the way it is today, it's quite an uncomfortable situation to be standing up here with a Russian airline. It's also uncomfortable because at Norges Bank, I was precluded from speaking about individual investments we've made. So this is actually the first time I stick my neck out in public and say, what have I bought? And given that we've looked at a wonderful business before in Ryanair, this is not a wonderful business, but nor do I think that it's about to die like all other flag carriers. This is clearly an unpopular stock. One can debate about how unpopular the industry is, given that even Warren Buffett has managed to invest in it. But what is clear is that this is a company with legacy issues. There's a lot of uncertainty. You've had the oil price working against it since last summer. So the stock has been very, very weak, which we think has created an incredible opportunity and a deep value case. Because what we see is a company with a phenomenal cash generation, actually pretty decent financial discipline given it's a state-owned company, and actually emerging tailwinds from a macro perspective, which we think are underestimated. We're also thinking this is probably less of a fundamental reason to own the stock, but there is the small matter of the Football World Cup coming up as well, which may drive some interest and certainly will be good for passenger numbers. And longer term, given it's a state-owned company, there might be upside also from further privatization of the shareholder register. So what is it? I mean, Aeroflot is a top 25 global airline based on IATA data, which is the industry standard. It has a relatively large footprint, about 150 destinations, predominantly connecting Europe with Asia, where Russia obviously has some geographic advantages. Aeroflot is the Russian legacy flagship carrier. It's 51% owned by the Russian Federation. Its main base is Moscow Sheremetyevo Airport. The company was privatized in 1994 and was listed 10 years later as sort of an amalgamation of lots of airlines. Currently, the fleet is about 332 planes, and they carry about 50 million passengers annually. The company actually has 4 brands. I'm not sure everyone is aware of that, but Aeroflot, of course, is the main brand. That's the premium and sort of business passenger. That's about 2/3 of the business. In addition, it has 2 regional airlines, Rossiya and Aurora, which operate a very, very different concept. And then finally, they have a mini Ryanair in there, Pobeda, which is about 16 planes, which has pretty decent growth prospect in our view. So in terms of the stock, it's a $3 billion market cap company. about $10 million of daily liquidity. It trades on undemanding multiples. That's no surprise. This is Russia. But when you look at it, you're trading on 7 times trailing earnings, 2.5 times book value, and that's despite generating about 40% return on equity and operating in a growing market. What's phenomenal is the free cash flow yield. Last year was 38%. We think we'll be around 30% again this year. So despite these attractions, and you can see how the share price has fallen, only half of the analysts rate the stock a sell, and the shares have been weak as the oil price started climbing last summer. So other than valuation, what is it that we see? Well, firstly, it's the dominant Russian airline. There's about 40% market share, and it's operating in a market with some pretty good long-term demand drivers. Their fleet, as I will return to, is young. That gives them a cost advantage, which I think is important in this business. Next is that jet fuel headwinds. So they don't hedge their jet fuel exposure, which means that they were under a lot of pressure in the second half of last year. But as you get to a situation now where the oil price headwinds are abating and the yield management is picking up, it actually means that the margin pressure will reverse and actually become a tailwind. And then finally, I think finally a little bit of potential improvement in perceptions around corporate governance. I don't think the company has necessarily been run very badly, but perceptions around corporate governance is about 3.5% stake, which is reportedly up for sale. That could also help. Dividend clarity would crystallize some of this value. So just a little bit on the industry. Everyone I speak to says that airlines is a bad industry, but I think given that it was a winner, was it last year, and we've had 2 cases this year, maybe that's changing. But the demand picture has always been healthy, 5.5% global CAGR, and there's very little variability on that. 5% passenger growth is very typical outside of demand shocks. But even over time, the demand shocks that you see in terms of September 11th, the financial crisis, they do tend to disappear in the big picture. This is a GDP multiplier industry. Typically 1.5 to 2 times real GDP multiplier on the demand side. It should come as no surprise. Bigger wealth, more air travel. That means that it is potentially, if you can keep supply under wraps, is a very attractive dynamic in emerging markets. If we look at Russia in here, it's down here. Historically, the market growth has been very strong. Expectations going forward are much lower, which I'll go on to show. So what is the position? So historically, passenger numbers in Russia have grown at 9% CAGR. When you take the company's strategic plan and their planning assumption, it's 2% going forward. They're not setting the bar very high in terms of how they're planning their fleet management, etc. They have a strong position. They have a relatively stable 40% market share. That's across their 4 brands, where of course Aeroflot is the bigger part of it. And even if you take sort of their bull case, sort of long-term, what they could do under a scenario where the market grows 2% and they grow 4 to 5, their market share would still remain below 50%. And I think it's worth bearing in mind, this is a growing market. Last year, passenger numbers in Russia grew 20%. Domestic grew 10%, international passengers grew 30%. Remember, this is a stock that's trading on mid-single-digit earnings multiples, and its market is growing 20% last year. If you look at their position in Russia, it is aided by their dominant position at the Sheremetyevo airport, where they have over 80% market share. This airport will double capacity this year ahead of the Football World Cup. Of course, they're not going to fill it all in the first year, but over the next 10 years, capacity is going to go from about 35 million in 2017 to about 80 million design capacity. You have runway for growth here. And their position at Sheremetyevo is I think, is pretty safe. They're already the dominant player there. They have an equity stake in the airport of 2.4%. They have their own terminal, so you cannot get away from Aeroflot at this airport. Okay, and why is that interesting? Well, it's the geographic blessing of Russia as well. You can see that the share of transit passengers in the mix is growing quite rapidly. It was 13.5% in 2017. That's up from 10% less than 5 years ago. Again, by using Moscow as a transit hub, especially for Asian flights, we think that the passenger growth forecasts are well underpinned. And then just quickly on the World Cup, it's not something that we model, it's not something that we try and be clever about. We just observe the fact that when other countries have hosted the FIFA World Cup, you've had a spike in passenger numbers. It has tended to be good for the flagship carriers in the region, but there can be multiple reasons behind it, and I haven't run massive regressions on it. It's just a fact. It will go on to people's radars. And who knows, maybe someone has a positive experience on an Aeroflot flight and we convert a Ryanair passenger or something like that. And this is onto the most important thing, it's the cost advantage. So this is the myth, right? Part of our idea generation, we were looking at airlines, we were looking at things that had done badly because of oil. Oil was going up. We tend to follow the oil price in Norway. And these things were collapsing. And my colleague said, oh, Aeroflot. No, when I search for flights to Asia, I always untick that box because they have such old planes. And I would never fly with them. So then I thought, well, if that's the perception, what's the reality? Well, the reality is they have the youngest fleet of any airline with over 100 planes. It's 4.1 years for the Aeroflot brand. If you take the other brands, they practically only fly Airbus and Boeing planes. There's 15% of the Aeroflot fleet, which is not Airbus or Boeing, are regional superjets, Sukhoi hundreds. They're perfectly suited airplane for what they're using it for, which is regional flights within Russia. Everything else is Airbus and Boeing and a few Bombardiers. So the fact that people think that they're going to fly Antonovs from the 50s is just not true. You might be positively surprised if you go on one of these planes. Why is this important? Here you see that the fleets are fit for purpose. So Pobeda, which is the low-cost airline, has the youngest fleet. It's the most efficient operator there. Less than 3 years average age. Aeroflot, 4 years average age. The regional, cheap, sort of old state-subsidized kind of travel to Siberia or what have you, they are 12, 13-year-old planes. They are your old Scandinavian Airlines type planes. But they are fit for purpose. And they've been managing the fleet consistently over the years. And that has now resulted in them having an incredibly competitive cost position. So if you look at sort of cost per available seat kilometer, it's about $5 cents, which I think is actually on par with some of the best low-cost airlines. It's half the level of other traditional flagship carriers. This is a company that has transformed. It is competitive, but the perception is lagging massively. And that is also, when I talk to my colleague, well, why do you have to untick Aeroflot every time you're making a search? Well, it's because they come up as one of the cheapest every time, and then, I don't want to see that I don't go on that one. It makes me feel bad. But it is cheap, and it can be cheap because it has the cost position to do so. And one of the cost advantages from the young fleet age is on jet fuel. So yes, during the bull run in commodities in the late 90s, early 2000s, airlines were a great hedge for the oil price in the US. Share prices collapsed over a long-term period. Was it because of the oil price, or was it due to oversupply? Who knows? It was probably a little bit of both. But the reality is, yes, fuel is an important cost component, is the biggest. It's about 25%. In a bad year, it could be 30% if you haven't managed your yield. But it's not what drives the profitability of the company over the long term, because they do manage the yield. What's interesting here is that when you look at a longer period, Aeroflot is actually positively correlated with the oil price, because Russia is dependent on the oil price. And yields are more important than your costs, because when Russia is pumping oil and sending it around the world, then people can afford to pay higher fares. They can afford to offset the cost pressure. So you can see that the company has been, steadily managing its yield with the oil price and managed to keep a relatively stable operating margin. And what's interesting is that at the third quarter stage in 2017, so the quarter ending the end of September, yields year to date were down 7.5%. Okay. They had been suffering because oil price was going down, Russian economy was slowing. But in the fourth quarter, yields turned positive, plus 1%. We are now going into a period where yields have been improving steadily, month by month by month by month. That will continue. You will annualize. By the fourth quarter in 2018, unless the oil price takes another leg up, you will have yields being positive and the cost headwinds on fuel turning to a tailwind. You'll be in a margin sweet spot again. And here you can see we've just taken the forward prices. So we're here. We have this behind us. This is when yields were falling because the oil price was falling. We have this behind us and we have this ahead of us. Of course, this changes on a daily basis what the outlook looks like, but I think it's fair to say that the worst is behind us from an oil price spike perspective. Okay, so what else could go right? So Aeroflot is a national champion. State owns 51%. That has some good sides and it has some bad sides to it, of course. Corporate governance is perceived to be poor. There are national champion type considerations. So in 2015, for example, the company had to step in when the number 2 player went bankrupt. That was at a cost of $300 million US. They also collect an undisclosed amount of Siberian overflight fees, which is basically from when the Soviet Union opened up its airspace and foreign players have to pay. That money goes to Aeroflot. We don't necessarily know what costs are put against that, but in the worst case scenario, those fees could account for probably a third to half of net earnings. Obviously, the European Union wants those fees to be reduced or cancelled altogether. But I think the company is moving in the right direction. So last year in September, the treasury shares, which had been a bone of contention for investors, was sold to institutional investors, so you can't do anything silly with those shares. Rostec, which is another part, or another arm of the Russian government, their stake is for sale. That is probably a bit of an overhang. It's roughly 3.5% of the free float. But the company is already acting well. So you can see the free cash flow generation. When oil was weak, they generated a ton of cash. We've tried to normalize the cash generation here a little bit because they tend to trade a little bit in terms of new planes and lease contracts and things like that. So this is a more of a adjusted pure operating capital generation. But this is a company that comfortably generates about 40 billion rubles of annual free cash flow. They will be pretty much debt-free on balance sheet by 2019. And as I said, the free cash flow yield of the current share price is about 30%. And they've been steadily paying down debt since the restructuring in 2013-14. So what we would really like to see is a bit more clarity around the dividend policy. So previously, they paid out 25% of earnings. That's still sort of the official line, The CFO says he would prefer to pay 25% of earnings, prefers to keep the money for himself. But in 2016, when the company had a really fantastic year, they were ordered by the government to pay 50% of earnings as a dividend. If that happens again, or if 50% becomes the new payout policy, then you have a yield of in excess of 7% on the stock, and it will be multiple times covered by cash flow generation. And then just a quick few slides on valuation. Again, it's not a growth case, so we've done it on trailing earnings. It's 7 times last year's earnings. Other than loss-making companies and Air Canada, it's the cheapest of the top 25 global airlines. I really liked the slide that was mentioned earlier when they thought about companies in terms of their peak earnings power. And, Aeroflot is trading on 4.5 times 2016 earnings, which was their peak earnings period. So again, the shares, if they have another kind of margin tailwind year, could really look very, very cheap. How do you value a thing like this? I started with my DCF. The cash flow generation is great, but the upside becomes so big, it looks a little bit silly because you have so much variability in terms of earnings. There are lots of moving parts. We've decided to value the company on a mid-cycle EV/EBITDA multiple. You can see the current multiples are 5.5 times 2018 earnings, 28% free cash flow yield. We try and lease adjust everything here. The stock is trading on 1 times lease adjusted EV to invested capital. The return on equity is close to 40%, and you're trading on 2 times book. What does our implied valuation look like? Maybe paying 12 times for a Russian airline, 2018 earnings, maybe on the lofty side. But if you do come out here and the growth that we've put in comes through, then you're back to sort of a single-digit PE multiple. You're back at, you're at a 10% premium to the lease-adjusted invested capital, which I think, given the return generation, is defendable. The shares have traded at these levels before. Here's 5 times EV/EBITDA on a forward basis. It would still be pretty cheap in a global context. It would, at 5 times EV/EBITDA, maybe not be the biggest value opportunity then. That is probably what we can be gunning for, unless you have very, very strong earnings momentum. But I think as a price target on a 12 to 24-month view is very realistic. We do also, I talked about the common sense check. This probably has no sort of fundamental backing or anything like that. But we just looked at what's the revenue passenger kilometers? What do these airlines actually do? How many passengers and how far do they go? And compare it to the market cap. It's just a massive outlier. Given its size, given its legacy, given its position in the world, I think it's just in the wrong place. Yes, low-cost airlines, they have better business models. They should be valued more highly. But I would argue that the risks at Aeroflot are not necessarily that much greater than investing in Turkish Airlines, and even that would give you 100% return if you got up to that level. So I do think that this is genuinely an outlier. It's a misunderstood company. The stock has been hurt by misunderstandings around the sensitivity to the oil price. It's been sold off with a number of other things, and that has presented the opportunity. So I think the risk picture in Russia is pretty clear. We read about it in the papers every day. I would say the one big company-specific risk are these Siberian overflight fees, which will need to be put into a discount on the valuation. And then just finally, I'm here with my colleague from sales, and he asked me to put the slide of performance up. Given that I joined less than 6 months ago, I can't take much credit for it, but I think with a couple more cases like Aeroflot, we can keep it going. So thank you very much.
Thank you very much.